You're listening to Freight Famous, presented by Rose Rocket, bringing you the people that make trucking move. From behind the scenes into the limelight. Here's your host, Justin Bailie.
Hello, everyone, and welcome to Freight Famous, the Rose Rocket podcast spotlighting the brightest minds in the supply chain industry. At Rose Rocket, we're dedicated to making the supply chain smarter and more connected. Our software helps over 100,000 people, from startups to large enterprises, streamline operations and stay ahead. We're passionate about innovation and expertise, which is why we bring top industry leaders to share their insights with you on Freight Famous. Learn more at roserocket.com. I'm your host, Justin Bailie, co-founder at Rose Rocket. Today, I am thrilled to have my friend and yours, Meghan Meurer, from the Tenney Group. She is the Chief Commercial Officer, and she's joining us to chat about M&A, mergers and acquisitions for brokers and carriers. You like this stuff. I swear, when I'm out on the road and I'm talking to people, and this is a conversation that comes up probably more than anything. Now, sometimes it's just like bravado, like, yeah, bro, I'm going to buy a company, or, but you're all interested in it. So listen up. This is like a quick banger. We just did this last minute. It's like 26 minutes of rapid fire, but you're going to learn a bunch and you'll know how much your company's worth by the end of it. So please do listen and enjoy. Meg, thanks for being here.
Thanks for having me.
So we are doing an impromptu podcast. We were given about 35 minutes notice that we were going to do this. We happened to have Meg on site today doing a dinner. She's hosting an event at our office to talk about M&A in transportation. And we thought it would be a great opportunity to get her on and discuss it with everybody who couldn't get down to downtown Toronto and grind through 2.5 hours of traffic if you're local, or have to fly in here and cross borders for most of our listeners. So this is a way for us to bring Meg to you. So I guess maybe the first question really broadly is, when we think about M&A in today's market, so we're sitting here in, late June 2024, how would you summarize the M&A market?
Yeah, I think the activity has really changed, certainly over the last 6 months. So Q1 was slow across the board, right? Interest rates really remained fairly steady. Transactions, certainly of substantial size, just weren't happening like they were 9, 12 months ago. And so what we're seeing now is certainly an uptick from Q1, late Q2. So we're hopeful that as the freight markets improve over the next 6 months, it'll continue to be steady from here on out.
And what kind of transactions are getting more traction? So if we think about, is it brokerages, is it carriers? Like what seems to be something that's, I don't want to say hot because I don't want to put words in your mouth, but what seems to be gaining more momentum maybe?
Yeah, asset light operations that are profitable and show certainly signs of growth, right? That trajectory, they're really able to stand out next to their peer subset right now, are getting a lot of traction in the market. I would say at our firm, we're doing, middle market, lower middle market deals, all within transportation and logistics. And about half of our book of business is asset heavy. The other half is asset light. Just depending upon the size of the organization, it appeals to a different buyer profile, right? And that buyer profile has equally changed over the last 9 to 12 months. So now buyers are, we have a lot of strategic buyers that are well capitalized coming out of COVID, ready to make investments either because of density, wanting more density in key areas, or just general revenue diversification.
So I was going to ask that. So you're finding that the buyers are folks who are in the industry.
Absolutely.
It's not necessarily PE or tertiary, in industries. This is a broker wanting to buy another brokerage, or an asset heavy wanting to buy asset light, maybe to add to just expand their business, or to your point, wanting just to buy more density in certain markets.
Absolutely. Yeah. I think about 80% of our buyer pool right now are strategics wanting to continue operating in that space and diversify their revenue streams.
When you look at, you and I, we just for full transparency, Meg and I, this is not our first time meeting. We've known each other a long time. And so we've had lots of conversations around this. But I'm curious, even because I think this changes, the question I'm about to ask, the answer to the question I'm about to ask is, what makes a deal? And this is for the listeners who are thinking. I think we are always thinking about this. At the end of the day, I'm just going to say something very direct: is that we do things for money, and so ultimately, when we're building these businesses, for certain, we're trying to create maybe generational opportunities in these types of things. But I think we're always there's not probably a business out there that for the right price wouldn't sell.
Sure.
And so if we can just say everybody's thinking of selling in their own way.
Yeah. Sure.
what are some of the things that make deals, and this is a bit of a loaded question because I think it's actually a hard one, easy to do? And what makes deals hard to do? And I know that there's probably a bunch of answers in there, but maybe when I say that, like, what are some things that really jump out to you is like, this is when these things are in place, this makes a deal really easy to do. And then maybe it's in the inverse, or maybe it's other things that make it hard.
Yeah, I think easy to do, scalability.
What does that mean in transportation?
Yeah, so on the asset light side, certainly, we're looking at things, well, on both sides, honestly, asset and asset light, free cash flow, right? So can an operator or buyer get in, and is it easily scalable? Much harder to do on the asset heavy side than the asset light side. And there's a lot of things that make transactions easier as well, right? Depending upon what a buyer is seeking. Maybe it's density, maybe it's client base, maybe it's vertical end markets that are served. But EBITDA margins, revenue, all considered, but free cash flow is incredibly important as buyers are, surveying and canvassing the market.
Just a quick question for my own. Why does free cash flow matter? Like, don't you take the cash does the cash stay with the business when you sell it?
Yeah, no. So free cash flow. So if they have EBITDA, but 40 to 50% is going back into assets, let's say,
got it. Okay.
or valuing off of the free cash flow that the business actually generates.
Okay, got it. Okay, sorry.
Yeah, and so a lot of asset heavy organizations or a lot of private equity per se, they might not want to buy real estate. They might not want capitalize whatever technology or assets, et cetera. But strategics do.
Right. Okay, got it. So it's sort of how much cash is spitting off.
You got
basically.
it.
Okay.
Absolutely.
All right, got it. And then what makes a deal, I guess it's the inverse to a degree, but maybe then let's kind of change the narrative of that question. When someone shows up to sell their business, what are some of maybe the common mistakes you will see, or what makes a deal a little less attractive based on just, the way that they've run that business or built that business prior to talking with you? Yeah,
a lot of owners don't think about displacing themselves, right? And so we talk to a lot of maybe second, third generation, and they'll say, hey, Meg, I'm exhausted. I'm done. I've just been the point of escalation in all things for so long. That's actually a huge risk from a buyer perspective, right? So not having a team around the table that is capable of running and operating the business presents a big risk from a buyer's perspective. So we get that frequently. Customer base is an interesting one where vertical diversification really matters, right? We don't want all of your eggs in one or two, clients. We want a pretty well diversified portfolio. However, the reverse is also true where some people come to us and say, well, I have 3,000 clients and I'm doing, sub $100 million in revenue. Like, that's not great, right? And so, and oftentimes what we see is it's a disconnect between the owners understanding what's driving value in the organization and their management team not also understanding what's driving value in the organization. So I have two examples of this. I had one recently where a gentleman, it was a sales rep, he was motivated and incentivized by more clients. Every new client matters. I get paid off every new customer. When in reality, the most profitable customers were already doing business with. So they had a tail on their customer base that was extremely long. They should have chopped off, 500 of those customers and injected that capacity in their most profitable freight. Pretty basic, but that's not how the head of sales was actually incentivized. And so it's like this disconnect between what's creating value and how you're managing your teams to create value. I had another one on the asset light side. This is probably about a year ago now, and their North Star was footprint. So they were so hyper-focused on their footprint that they wanted more and more locations. And I think they had about 12, and they wanted to go to 30 in a fairly short period of time. Again, because the head of operations and their COO was really motivated by their footprint, right? Going to market, it's usually something you tout. I've got 30 locations. I've got 2,000 trucks, right? Well, that's not always what's driving value for the company. And so what we noticed is that every incremental location that they added, it decreased their margin profiles. So like what they thought was scalable from a process, procedure standpoint at the corporate headquarters, it actually degraded every new location that they brought on, which ultimately was devaluing it. Maybe there's some balancing out that happens over time, but in the short term, going to sell, it wasn't helping their go-to-market, pitch to buyers.
Yeah, it's interesting because it's like you are building a narrative for, to your point, to acquire more business, right? You're like,
sure.
Like to your point, we have 30 locations and look how big we
That's
are.
right.
And therefore we can get bigger accounts and just have more gravitas when we kind of walk into rooms.
Sure.
But there is this, and so maybe that kind of brings me to the next point. It's like, or question, if you are, okay, how long should you be planning ahead if you want to sell your business?
Sure.
How long, and I do want to flip this to a buyer conversation too, but as we'll talk about sort of sellers, I guess again, just bear with us. We're doing this totally on the fly here. So if you're thinking as a seller and you want to sell your business at one point, what is the right amount of time?
Sure.
And what are some things that any business can do between now and said time to put themselves in a better position to make for a smoother and ideally more profitable transaction?
Yeah, so I would go through the educational process as soon as possible, right? You can go through this process not ever wanting to sell or in the near term wanting to sell, but understanding how the market is valuing transportation and logistics companies, right? So most investment banks have a complimentary profile that they'll walk you through where they'll talk about valuations, how deals are trading in the market of your size, and then walk through deal structures, right? Cash at close relative to contingent consideration, buyer profiles, but go through that process. It's complimentary. You share minimal financial information and get a pretty good output of information around how the market would view your operation. And then from there, you can talk about what are the factors that are potentially pulling you back or could help you, whether it's pro forma or future looking, that can drive value when you do go to market. Usually we advise clients, prepare for 9 months. The process could take longer. It could take a shorter period of time. But if you prepare for 9 months, having data that's accessible, that you can easily flip in various capacities, right? Whether it's ERP or TMS or whatever you're operating on, making sure data is at your fingertips and you can easily get it across to an investment bank to put a SIM or confidential information memorandum, fancy PowerPoint together to go to market. That's really important. That creates a lot of lag time if you don't have that easy data at your fingertips.
And if I'm looking to buy companies, how do I don't want to use the broad terms like how do I think about this, but what are some maybe on the buyer side, what are some mistakes because I think sometimes the mistakes can help inform the victories a little bit. And so what are some mistakes that buyers, and maybe in that not executed on the transaction, but in the discovery, I'm thinking about buying a company. What are some of the maybe false pretenses or narratives that you often come across with people at that phase?
Yeah, I think the hardest part about the buyer side is really understanding what their parameters are and what they're looking to accomplish.
Right.
So like if they don't know their pain points or the synergies that they're solving for and they want to do acquisitions just simply because organic growth is very challenging right now, that's super problematic, right? Because you have to be solving some specific pain point to understand what are you looking for? How do those deals trade? What is my competitive advantage? Are we trying to go after market share? Like what are we trying to, is it driver based? Do we want more, do we want more capacity? Do I need density on my power lanes? Like that creates a bunch of problems. And what we see is if you don't have those parameters that are crystal clear, what happens is buyers will look to acquire companies and it might be within their strike zone. But then there isn't always alignment between the executive team, right? There might be a board or advisory committees, and then you've got a full board of directors, and then you've got shareholder approval, and that process just takes a long time. And then you're constantly spinning your wheels on the next deal because you don't know what you're solving for, or not everyone's aligned in that process.
And then when transactions eventually occur, like how does a buyer protect themselves? The one thing I've not really, maybe I think I do understand it, but I'd like to sort of hear you answer it. I'm going to buy a brokerage, and what I'm really buying is, some sort of operational infrastructure. But I'm going to assume that I already have a brokerage, so I can look at some redundancies there, and I can fold some of that in and capture a little bit more margin as a result of that. But many times you're often buying sort of, I'm going to call like owner chutzpah, where it's like, how do you assess the risk of the founder magic leaving a business when you sell it? Like, how do you know that business is? I mean, this goes back to your point about like seeing like a layer of management underneath, or like is the owner maybe already half out of the business, or like what are maybe some ways of de-risking? Because I just think of my own lens as a buyer, that's the thing that kind of freaks me out because it's sort of subjective a little bit too. So I don't know how do people think about that or solve for that?
So most buyers in the process, right? There's multiple management calls that are happening that aren't just with that C team, right? So they want to know personally that layer underneath. How are they motivated? What drives them? How's the business actually operating? Not from the executive team. So that's all part of the process when you're going through diligence. But yeah, I think ultimately, you want that owner that's transitioning to stay on board for some period of time. And that all ties back to the valuations, right? Are you on the high end or the low end, depending upon how much cash at close you want? you want a buyer to be on board for a certain period of time, at minimum, to transfer trust from the key accounts to the new buyer. And that's really important in the process.
How long was typical there?
Yeah, you can see anywhere from 1 to 3 years.
Okay, right. And why would somebody use someone like Tenney to do this? Like, I totally know the answer, but it's like, it's if I'm wanting to make a transaction, it's not cheap using investment banks, right? And so it's like, I'm just going to go, I'll just do this transaction myself.
Sure.
Right. Yeah. I feel like I'm saying, like, why wouldn't you buy a house yourself? But like, and probably even more complex, since it's actually even bigger dollars than that. But what are some of the things that an organization like Tenney kind of helps to bring to the table to, make these transactions? Like, what's the value you guys offer?
So I would say that most people that are going through this process, if they want to get acquired by a sophisticated buyer, right, which many do, they're middle market companies, they want to get acquired by someone who's going to take that growth trajectory to the next level. Right. They need someone to level them up through the process. And they're not experts in an M&A process. Right. And so that initial value might be bringing multiple buyers to the table. So you maybe someone's knocking on your door and you already have an offer in hand. But is that what the market would bear? You don't know unless you're going to go out to market. So we try to get multiple competing offers on the table within a 90-day period. So you can assess and understand that. I think that's the first kind of step. But really, the majority of the value comes from LOI to closing. And so negotiating all the various points through diligence, all the way through purchase agreement negotiation, employment agreements, retention agreements, and closing, like that process, if you haven't been through it before, there's so many different nuances that come up that are specific to transportation and logistics along the way too. And it's not just the investment bank. Like we would advise you to have, an M&A attorney present. Maybe you have a wealth advisor. Maybe you have someone like a KSM that focuses on tax implications. So it's, your investment bank is maybe one of a handful of advisors around the table throughout the process. But if you've got a large, sophisticated buyer that is a prolific acquirer and goes through this repetitively, you want to be on their level when you're going through the process.
Yeah, great point. Yeah, I feel like you get pantsed pretty hard there.
Absolutely.
If you're in the wrong.
You got it.
Yeah. So how many deals, like when it gets to the LOI stage, how many transactions complete from that? This is more just my own curiosity. Like I'm interested, like do a lot of fall apart? It sounds like there's a lot of due diligence that's kind of occurring there.
Sure.
And I feel like especially kind of mid-market businesses, there are bodies buried in these businesses at times,
absolutely.
to use a pretty derogatory term.
Yeah, sure.
So I just feels to me that there's probably still maybe quite a bit would be strong, but there's some level of risk. It feels like even
absolutely.
from so what it maybe like how many deals don't close or do close?
It's so hard in the middle market space. I mean, some firms will be at 50%, or others will be at 60 or 70%. Some will tout 90%.
Right.
I call BS most of the time on the middle market deals. But
so I didn't know this. So this is actually a selling point for firms. They actually will talk about this as a selling point.
Some do. But it's all dependent upon what their volume looks like, what type of deals they're bringing on, the competency of both the buyers and the sellers at the table. Like there's a million reasons why a deal can go south.
Yeah. So it's just interesting though. So I'll take that. And I didn't realize it was such like a competitive thing. So I won't poke on that as hard as I was going to. So, but you're saying that like there is like, so there's a kind of like calling bullshit on the 90%. So it's somewhere between 20 and 50% of deals on it like really won't close even after LOI.
Well, so here's a different way to look at it.
Yeah.
What I think would be most important if I'm selling my company is throughout that process, understanding how close you are to the buyer pool and some firms
what does that mean?
So the buyer pool, if you have relationships with them, like direct relationships with whoever's out there in the market, we try to reverse engineer to the buyer's acquisition strategy. So I don't want to have my commercial team go to market unless I know the acquisition strategy of all of the top buyers in our segments, right? But, throughout that process, a lot of deals can go south for a lot of different reasons. I would care more about, of the buyer profile that we put in front of you, how many are actively engaged with us, returning NDAs, setting up management calls, right? So some firms will tout, I'll go out to 3,000 people and I'll blast my CRM tool with your deal, like biz by sell. Like we'll post it on our board.
Put it on Facebook.
You got it. So I would care much more about who is the buyer pool and what is your rate of return on those conversations, right? Are we engaging the right people? Are they interested? Are they responding? Do you have an NDA in place? Are we setting up management calls? That is a really important metric. And so our firm, we always strive for 90% out of the gate there. And I think that that's a really important metric to measure because a deal can go south really quickly if it's just a broad, we would say a big list, a big outreach list for us would be anything 50 or more, 50 or more companies.
Right.
So that's a pretty tight-knit group where if we know that vertical, we know the space, we know the buyers in it, we want the right people on the list, and we want to really reduce our time in the process to get a deal done and get competing offers on the table.
Got it. Yeah, and that makes perfect sense. And I think that's, again, it's more of a we call it sort of like account-based marketing, more of a strategic precision approach to
absolutely.
who the buyers are and just being a little more quality versus quantity, I guess.
Absolutely. Yeah, sure.
And so if you are, so let's play the game. So we're going to be I am and this is going to be tricky, I think, to a degree here, but no, let me just ask the question. Like, what are the multiples right now that, an average, call it broker with sort of revenue between 10 and 25 and maybe 25 and 50. What is it if you just average? Like, I get there's more bigger, I get there's lower.
This is my favorite question.
Yeah.
What is my company worth? I know nothing about your company.
Because isn't this the question you always get?
Yeah,
right? Like,
of
is it like,
you're
going to do dinner tonight? And people will be like, what's my company worth? Like,
you have no idea.
Context.
You have no idea.
So this is all I'm asking for, is because I think it's, okay, maybe let's talk about how they're valued in terms of like, okay, so it's a multiple of EBITDA. That's going to be the thing. Yeah,
the majority of companies are based on a multiple of EBITDA. Some, if that doesn't make sense financially, they're sold at a value of assets, plus some goodwill or drivers that are carried forward. But the vast majority are multiple of EBITDA.
Okay, so we're spitting out X amount of cash flow. Again, we'll play the average game. Okay, we've got
just do EBITDA.
Let's just do straight up EBITDA.
Yeah.
We've got a brokerage that's been around. It's not super old. It's not super young. It's got decent client density, but not perfect.
Risk. We have no risk. Your risk profile is zero.
Little risk, but it's also like it's a C+ organization when it kind of all comes down to it.
Okay.
And the owner would believe they're a B, and you'd say they're a C+.
Sure.
So if you're sitting here listening to this, you're like, I'm a B. No, you're C+. So what are the, again, roughly, and we're not going to hold you to it, and I know the market moves. I don't mean to put you on the spot, but I do.
Yeah.
So what is that? What would someone, what is their business worth?
Yeah. I mean, it really varies, but it could be, if it's sub 5 million in EBITDA, 4.5 to 5.5 times is like 80% of the market will respond there.
Okay, got it.
Right. So I'll be conservative always because I want to remove outliers below or above. But it really just depends on the type of freight, how specialized is your organization. Like, there's so many factors that go into it. Does that apply to assets too? Or is
absolutely. So brokerage and asset, they roughly trade at the same
it depends. Like if asset light typically will trade higher the larger the organization. Just because they're highly scalable, less CapEx involved, et cetera. Right. And more free cash flow.
So is there a diminishing return from size? Like, can you get too big where the multiple actually starts to erode at a certain level? Like, is there a sweet spot here or an equilibrium?
I mean, so we're middle market deals. So we'll do anything up to about 25 million in EBITDA. But I mean, the multiples, they vary slightly over that scale, of course, but it's more about the deal structure that changes. Right. And so it's all about, a great way to bridge the valuation gap is contingent consideration.
So what does that mean?
So do you have an appetite to, I have some people that are selling that say, hey, Meg, I want 100% cash at close and I want to be done tomorrow. I'll give them a valuation range and I'll say, okay, Joe, but that's the lowest end of the valuation range that we're going to give you. Because it's tremendous risk, from the buyer.
Of course.
So the more shared risk in the deal, the better valuation you're going to get.
Got it.
So if you're willing, Justin, to have 70% cash at close and 30% contingent that ties you up for 24 months, and you're going to maintain gross margin or your key clients, et cetera, that's going to be advantageous throughout the process.
Got it. So I think that's actually a good point. And we get hung up on this. We say, what's my business worth? And the depending is not necessarily just on like the, we'll call it the health of the business. It's on actually the structure of the deal.
Absolutely.
So it's on like, how much can you de-risk the deal?
That's right. You got it.
Which will then obviously, and it's like, this is kind of life, right? It's like you will obviously, the greater risk comes with a reduced price, right? Better reward, which will therefore be, but ultimately that manifests to a lower purchase price. So that's such a good point. And I think that's good and I kind of have known this, I guess, from my previous conversations with Meg, is that, as a group thinking about, and listeners thinking about your own business and thinking about selling your own business, we are we do need to think about it beyond just the multiples of revenue. Is the structure of the deal itself.
Multiple EBITDA, yeah,
Right?
is the structure. Absolutely.
Exactly. 'Cause
Yeah.
if you're on a 36-month 100% earnout,
Sure.
like, okay, you got 8x, but
That's right.
man, I hope you get there.
Exactly.
Right? Like, I hope
Absolutely.
you get there.
Yeah.
And because
and making sure that you have a firm that is going to, I've heard horror stories, right? These guys that lose that second check based upon $1 because they didn't make a base rate.
Crazy.
Like making sure you have an investment bank that's tiering the structure of the contingent consideration. Like
Right.
you make 75% of it, you're paid out 75%. You make 130%, you're paid out 130.
Yeah.
There's just some basic mechanisms in the contingent side that can protect the downside.
Is that just like housekeeping question on this? Like, does that money go into escrow? Like, how do you ensure that they actually follow through on that check? Or is it like you just
Us
have
as
to,
Tenney or?
No, like I'm just thinking like a buyer. I'm like, I'm going to do like an earn out. Say just for those who don't know what that is.
It's all,
like
contractual.
You basically hold back money for certain performance obligations along the way. So I'm going to give you, I'm worried I bought a brokerage that as soon as I buy it, all the customers are going to flee, and I've basically bought vapor.
You got it.
So I'm going to hold back as a buyer some money to make sure that these customers stay on over some period of time.
That's right.
Does that money from the buyer have to go into like an escrow account, or is it just like it's I don't want to say goodwill, but just contracted that they have to cut that check?
Right.
Okay. So anything else that we turn this into like a quick, like, how do I get my business ready to sell, or how do I buy a business? Q&A. Is there anything else that you'd want to offer out to the community just on how to be thinking about these things, whether you're a buyer or a seller?
Just start the educational process, right? I mean, there's so much material out there. And like I said, a lot of complementary services that go through this, not just with an investment bank, but your tax advisor, right? Your M&A attorney. Like the process varies for all these advisory groups. So educate yourself. Succession planning, right? We didn't really touch on that, but there's a whole group that really wants to transfer ownership to the next generation or cut that next generation in differently throughout their exit. And so that's an important topic throughout the process. I've got a kid in the business that is not to the point where they can take it over, but I want them to have a portion of equity and I want them to be tied to the earnout, right? And so there's a lot of creative ways that firms can help you accomplish those type of objectives.
Okay. And where because this is going to create people are going to want to talk to you. So how do people find you?
LinkedIn or on our website, tennygroup.com.
Okay, amazing. Meg, this was awesome. Thank you for doing this on the spot. And thank you, crew, for setting this up for us really quickly. Be well. Be sure to like. So there must be other, okay, look, I'm not up to speed on the subscribe narrative. I bet you there's newer things like a fist pump or something out there in the social media world that I'm just becoming too old to understand. So whatever those things are that promote the show, where you can tell other people about this, I'd love for you to do that. Thank you. Be well.